This video is being recorded during a time of volatility, but actually that could have been at some point in any one of the last 30 years. I particularly wanted to address those clients who, when things are down and seem to be down drastically, to ask them to keep their perspective. And as long as you are an investor and not a trader, then maybe taking a little bit of a look at history might help you keep that perspective. By trader, I'm referring to somebody that would be looking at the markets pretty much all throughout each trading day and acting upon news or their strategy many times throughout the day. An investor is really someone who has money in there for the long term, looking perhaps in my case for most of my clients, those people that are looking to fund a plan over the course of several decades. So let's look at a couple differences. This chart is illustrative of a candlestick chart, and what I mean by that, you see every bar in there looks a little bit like a candle, and what that represents is where the market opened that day, where it closed that day, and potentially the highest or lowest price during the course of the day, and that's where those little lines or wicks would be showing. So if you were a day trader, you would be looking to capture somewhere in the higher part of that day trade, and you'd have to be watching it pretty much throughout the day or have a specific strategy built in on when to buy and when to sell. So as far as selling, how low do you go? Well, I know there are some books that I've read that talk about investing in the markets where they suggest that you use a level of perhaps 5 to 8%, meaning once it goes below that level, if you're a day trader, maybe you should have the discipline to automatically have that money, have those stocks sold so that you never do go too low to where it's causing you further damage. The same could be said for on the high side. Maybe you want to set a limit to where you sell. I'm happy with a 2, 3, 5, 10, 15% profit. Grab it, put it in cash, and then live to fight another day. That is a very active way to manage your accounts, and it really doesn't make sense for someone that's trying to produce income over the long term. So now let's discuss the perspective of a long-term investor. I pulled up a chart here from Franklin Templeton Investments that shows a series of returns for the S&P 500 from 1992 through 2021. And what this illustrates is, if you see the two different colors, it's showing the low for the year, which would be in the purple, where that year ended up would be in the teal color. So you can see some years ended up high, some years ended up a little bit lower, but if you looked through 1992 in the S&P 500 using total return, stock price plus reinvested dividends, we're only seeing a handful of years where the market actually ended up negative. That's so for as an investor, if you don't know intraday what all those moves are going to be and you're temporarily down, this chart should be helpful to show you that if you did write it out, more often than not, your investments over time would have done just fine. And to stretch that out with a little longer perspective, this is just a basic chart of the S&P 500 from 2018 through 2022. So it's not one of those long since World War I charts, since most of us haven't been investing since that time, but this should be relevant to most of you, even with some of the very dramatic market volatility swings that we've seen. You would see that as a long-term investor, even with the current volatility we're in, you still would have done okay. So the amount of time that you're going to be invested should correlate to when you need the money. If you're looking to buy or sell or make profits daily, then you're a trader, you're not an investor. If we're talking about your retirement nest egg that should last you many decades, then you're an investor, and I certainly hope you keep that perspective and continue to behave like one.